And it's 10 a.m. right here in Lagos, Nigeria. Good morning, good evening. Wherever in the world you're watching from, it's Business Morning live from Channels HQ. I'm Ladi Williams. It's great to have you join us. Let's kick off your morning now with some market performances there. We see oil prices edge higher today on hopes of a recovery in fuel demand as China continues to ease its COVID-19 restrictions, though gains were capped by recession concerns and restarts of some U.S. energy plants shut by winter storms. Brent futures for February delivery rose 9 cents to $84.42 a barrel, an early trade, while the crude advanced 10 cents to $79.63 per barrel. Amid the optimistic market mood, both benchmarks hit their highest level in 3 weeks on Tuesday, and that was yesterday. The hopes for a boost to demand for fuel in top crude oil importer China comes as the world's second biggest economy moves towards reopening its borders next month after 3 years of stringent curbs on movement and businesses to counter the spread of COVID-19. Chinese hospitals were under intense pressure due to a surge in COVID-19 infections as the country moves towards treating the virus as an endemic. And 2 months after its listing on the Nigeria Exchange Limited, major electricity generating company Geregu Power PLC has announced plans to divest minority of its stakes to the Afrexim Bank development arm, FEDA. The Fund for Export Development in Africa explains that the planned acquisition is part of its strategic intervention efforts in Africa's energy sector, and in line with releasing Nigeria's power sector roadmap. In a statement, the chairman of Geregu PLC, Mr. Femi Otedola, says in a period of contracting economic activity globally, to attract this investment from FEDA is a testament to our long-term strategic plans and will accelerate our expansion to the wider West African market. In his part, the president of Afrexim Bank, Professor Benedict Orama, explains the move marks a critical step towards supporting Nigeria's power sector and advancing Africa's industrialization and energy security. The chief executive director of FEDA, Marlin Ngoyi, shows its ability to harness opportunities in sectors that are critical in driving the structural transformation of trade on the continent. The FEDA Afrexim Bank and Geregu deal is subject to satisfactory diligence and documentation among parties. And rising inflation, low GDP growth, low external reserves and revenues, as well as low crude oil production were some of the economic shocks the Nigerian economy suffered in the year 2022. Well, thanks to challenges of insecurity, oil theft, and the Russia-Ukraine war and flooding, we saw the government intervene through various policies to revive the economy. Turn our attention now to the economy as continue our review of various sectors in 2022. This one is the Economy Review. Take a listen.
The year 2022 started with high hopes for Nigeria, as projections by the World Bank revealed that the country's economy would grow to about 3.8%. For an economy that was only trying to recover from the global effect of the COVID-19 pandemic, that projection was good news. However, all that began to change owing to the disruptions caused by insecurity, low revenue generation, especially arising from a deep cut in crude oil production. The Russia-Ukraine war has also impacted the economy, as some critical imports such as wheat continue to be disrupted. By the end of the third quarter, the World Bank advised that the nation had to make hard choices or face a worse economic downturn in the months and years ahead, as it reviewed downward its growth projection to 3.1%. The World Bank backed its advice with some economic realities, such as slow economic growth in the third quarter due to a weak performance in critical areas of the economy. Key macroeconomic indices such as the rising inflation currently at 21.47% as at November, from the October rate of 21.09%, low debt to GDP ratio, low external reserves, sharp cuts in crude oil production, flooding, job losses and revenue shortfall still raised concerns.
Once there is security, investment will come. Investment cannot come without security. First thing first, you are not also sure that your investment will be safe because of insecurity. That's number one. Then number two, once the insecurity comes, people will invest in manufacturing and they will invest in agriculture. Agriculture has to be revived. And revived in a way that agriculture works in most countries.
With these new trajectories, it may just be high time for the government to change its plans. While Nigerians were still grappling with the rising inflation and its attendant effect on food prices and the general cost of living, then came the floods, with devastating effect on farmlands and crops. Virtually every state in the country was seriously affected, displacing over 1.4 million persons. Approximately 2,776 persons were injured, while 612 persons lost their lives. This, however, came with assurances from the government through the provision of relief materials and funding to boost dry season farming to cushion the effects.
The bank released the sum of 57.9 billion under the Anchor Borrowers program to 185,972 new projects for the cultivation of rice, wheat, and maize, bringing the cumulative disbursement under the program to 1.01 trillion naira. Disbursed over 4.2 million smallholder farmers cultivating 21 different commodities across the country.
Notwithstanding the current situation, the government says it's taken hard decisions to improve key economic indices and insists that the nation is not broke, given its debt stock and other worrisome economic indices.
Oil revenue is underperforming because of the criminality, but recently NNPC has reported that that has been curtailed, and we're already beginning to see the pick up in the production volumes, which will mean that more revenues will come to the Federation. You're broke when you don't have anything coming in.
And just before the end of the year, the Apex Bank in October came up with a policy to redesign the Naira. The bank cited reasons such as the need to take control of currency in circulation and address the hoarding of Naira notes outside the banking system, the shortage of clean and fit notes in circulation, and the increase in counterfeiting of high-denomination Naira banknotes. This was then followed by the pegging of the limit of cash withdrawal at 20,000 Naira daily withdrawal limit on individual accounts and 50,000 Naira limit on over-the-counter third-party checks. This generated a lot of debate from Nigerians. And after a back and forth with members of the National Assembly, the central bank increased the withdrawal limit to 500,000 Naira weekly for individuals and 5 million Naira for corporate bodies, but with strict conditions. As the year 2022 winds down, many hope that the right economic policies and decisions will be made going forward, such that the economy can find its footing in 2023 and beyond.
And now to our first conversation now. We'll be looking at the manufacturing industry now. We saw a recorded negative growth of negative 1.91% in the third quarter of this year. And the contribution of the manufacturing sector of GDP also declined from about 8.96% in the third quarter to 8.59% of real GDP in the third quarter of 2022. Well, let's get a review now. Let's talk to Mr. George Onofowokan, CEO, Coleman Wires, join us here in the studio. Great to have you on the program, and compliments of the season.
Great, thank you. Thanks for having me back.
Wow, quite a year for the manufacturers. We've seen the forex issues, also had currency devaluation, rising cost of inputs, and others. How did you manage?
I think for most manufacturers, this year has been more of a roller coaster. But have we managed? I think we've managed better than most people expected. As a country by now, where we should be, it's more like disaster recovery. But I think we've fared better than most. The negatives we're seeing really should have been worse. But I think the major part of it for this year is that people planned for the worst. We did not assume a sort of optimistic year as we all estimated. But as each crisis did happen, really, because you were planning so far ahead, you managed the crisis better. The FX issues, the interest rate issues, inflation issues, all those were impacting us negatively, no matter how you say it. And by the time you put in the figures, of course, you're going to end up with a negative. So for most manufacturers that have even come up with a negative and a decline, that we had a GDP at 8.96 and a negative position of 1.96, I think we should actually be applauding most manufacturers to have survived at that level. Because if you look at it, Nigeria today, if you look at inflation rate at 21+%, if you look at the impact of FX, from the year beginning, if you take off the parallel market at about 500, which went to its highs of 900 at the end of the year, back to the 700, take the official position, which has always ranged between 412 to 440, and you're looking at those negative impacts. FX rate impact, basically the FX risk was a bigger risk to most businesses because it impacted businesses at negative of over 40%, 50%. And how do we look at ourselves today and not tap ourselves on the back that we survived? I think the critical word for most manufacturers, you applaud them for even surviving.
Survival.
That was the real thing.
All right, so we've seen the global central bankers have raised rates, and it's like a non-stop process, at this time. And even back here, we've seen the central bank governor also raise rates. The MPC, they've raised rates about over three times this year, and the expectation is rates will still keep going up as long as inflation, keeps rising, even though it's rising at a slower pace. But what is cost of credit like right now?
Cost of credit, of course, has gone up. Oh God, ridiculously. I think the first basis of increase, first two impacted, but I think everybody was still watching. I think by the time we got to the third one, and when we're getting to 16.5, I think the whole financial sector woke up that I think we're not charging banks, their customers more than, not enough. I think that's the right word. And the next thing, I think for most businesses, rates shoot up relatively more than 25%. Now you're saying some better averages between 22 to the 25s, but it went up as high as 30% for trade, and you're talking 28% for some businesses. Now, well, it's relatively getting a bit better now. I'll say it more like in the last 1 month. People have started reviewing, because really the negative impact of interest rate increase, of course, is business will slow down. Yes, technically, inflation goes up, you move interest rate going closer to inflation to impact the negativity of inflation to actually slow down the economy so that inflation slows down. Now, but at the end of the day, you're trying to slow down inflation. The effect of that is you're clamoring on liquidity by increasing interest rate. Increase interest rate, it will slow down people's expenditure, capital spend. It will slow down their way of buying. Now, but at the end of the day, when you start slowing down the system, you get the negatives. Now, especially for manufacturers and industry, that people like us who are impacted double whammy at the end of the day. You've gotten the interest rate risk issues, which is increasing at the pace at which is increasing. Then you also have the negative issue of the FX issue, which is impacting you simultaneously. So if you take your double whammy, you're talking businesses taking an impact of over 50, 60% on a year-by-year basis. Now, how do we then look at how do we mitigate that? Some aspect of it, give them the right thing. Yes, you've had all the intervention funds from everywhere you could think about. If not for those intervention funds trying to mitigate these increases, that has happened, I think, more than 3, 4, 5, 6 years now. I think that's been the lifesaver. You had people that had already taking benefit of the intervention funds. You had 9% interest rate. During the COVID, it was 5% interest rate. So most businesses benefited. Now, you saw that benefit happen, and it trailed on. Now, the impact of the commercial rate going up against the MPR was not as heartfelt as it would have been if there was no intervention. So give and take, one of the good things was the government and the CBN did right with the banks to do that. to mitigate what was going on the other side between the FX and the interest rate. Now, but at the end of the day, take above board, take across board, yes, there's still a negative, no matter how you look at it. And the question is, how much negative impact can we take? And we have to be very careful. Just like I was speaking to some bankers off the record, and you're looking at it, impact of both can create one major factor, which nobody wants to go back to for the bankers, NPL, non-performing loans. Now, the more you impact industries, the more you put negatives onto the system, the less people are able to pay, the likelihood your NPL figures for most banks will start going up. Then we go back to a crisis scenario. So there must be a balancing act. We need businesses to survive. We don't really need businesses to go down the drain, and then we have another crisis in the financial sector. So for me, I think what we need to do as a country, what we need to do as a financial sector is to create a balance. Now, how do we create that balance? That's the key question. The intervention funds, though, cannot last forever. Interest rate issues, yes, has to continue to go up because we still have an inflation at 21%. So most likely, as you just said earlier, it would still go up now because they're still trying to mitigate. But we need to create more alternatives to the impact that will enable businesses to grow, which means we must find alternative businesses, creating local content, for instance, which has been good. You have local content in most oil and gas. We need to make impact to pushing the impact of the negatives. Are you getting my point? So when you're trying to make impact, pushing the impact, you need to get these industries getting businesses. You need to get them working. You need to get most factories working. So if you take the oil and gas, for instance, which has a local content law, which has a benefit. Today you have a Train 7 that has $12 billion in project. And today they can say they have 55% local content out of $12 billion. So you've got, the more you can get other projects having more local content, I think we can pull ourselves out of our sorrows. And those are the key things, is to find ways for all industries in every way to sustain whatever they're doing in their businesses. And also we need to be very careful that policies that are created by government, irrespective like just like the excise, because I'm chairman of my state manufacturers, and I have a lot of beverage companies in the state, for instance. And you have the excise law, which is now putting 10 naira of every liter of, and it's a big impact. The whole of the members are shouting and screaming about it. We need to ease. We're not saying it does not make sense to actually charge, but how do you ease?
It was like a double whammy for everyone here. The government looking for revenue, at the same time, and, trying to provide the enabling environment for businesses.
But they must continue to create a balance. The businesses are the ones that are paying the bills. They're the ones paying the taxes the most. They're the ones, if you look at the tax revenues, when you look at your VAT revenues today, if you look at your tax revenues today, income generated from pay, they're coming from private sector-driven businesses. Now, if those businesses survive today and tomorrow, the government continue to earn more. If those businesses grow, you're guaranteed to earn more tax. If I'm more profitable, I pay you more tax. If I'm doing more sales, I pay you more VAT. Those are the realities. So if you stifle them and they die, what the heck are you going to collect? That is the point. So we need to be factual. We can be as technical as you are, but the reality is survival of the businesses and the growth of the businesses, which they've implied with all the intervention funds, lowering interest rate during COVID, is that they understand that those industries need to survive. If they don't survive, you're looking at 9 trillion that's been given in intervention fund today. 31% went to industry alone. Now, we believe more should be given to industry than they should have given, but nevertheless, it's a balance between today's world of agriculture and industry. I think agriculture has fared a bit better than we have in the figures, but the rest of it, you can't have agriculture without processing. Processing pushes it back to industry. And that is the fact that we need to push industry to the level at which it survives and takes us out of each crisis. So we're going through a crisis. We're going to 2023. What do we see at the outlook of 2023? I think the outlook is still a bit positive. Because
even with the uncertainties.
Even with the uncertainties, because luckily for us, certain things have been taking place that, if you look at it from the background, and let's ignore the government issues and all that stuff, a lot of projects are in play. Modular refineries are coming in play. A lot of investments have gone into more modular refineries. The Dangote refineries is there. Petrochemical refineries are coming up with plastics, and those will set up other industries. Apart from that, infrastructure spending is a bit better than it used to be. And when you look at those factors and where the growth is, there's a gap. You have 200 million plus people, there's a gap. When there's a gap, there's investment. And I take, for instance, look, Ogun State happens to be the industrial capital of Nigeria, and I see the number of businesses growing. And if I look at the number of businesses putting factories in Ogun State alone today, it's astronomical. And people are putting long-term investment into things that you won't believe that is happening in Ogun State. If I look at the number of businesses that will open in 2023 that are under my own purview, it's a lot. But we must take that outlook, because there must have been a good reason. Nobody invests in anything and makes a loss in it, especially if you're taking people's money, investment money, you're taking banks' funds. You're not looking at the negative, you're looking at the positives. And I think the positive is, irrespective of the political risk that we have next year, give or take elections, take that off the benchmark, look at the consistencies of the investment in the intervention fund, investment in industry as of now, today. I'll say 2023 is still stable.
Stable.
The word is stable. It's stable. We're not in a negative. It's stable. The only risk is for every business today is to take a very good outlook into managing both the FX risk and the exchange rate, which is the exchange rate risk, and also managing their interest rate risk, because that is fundamentally going to affect all of us.
Right. So, well, a lot to look out for in 2023. Just a couple of days away, and we hope for a better outing, for the manufacturing industry going forward. Thank you so much, Mr. George Onofoka, CEO, Coleman Wires. It was great having your perspective today.
Thank you very much.
Thank you so much. All right, we're looking at the manufacturing industry in retrospect for 2022. Now, we head on now to see how investors, fared in 2022 and expectations for 2023. That's our next conversation. Do stay with us. Welcome back. Now to our next conversation. Well, 2022 definitely been a tough year for investors globally, with inflation causing a rethink for most investment classes. Let's get a review now with Mr. Ayodeji Ebo, MD and Chief Business Officer, Optimus by AfriInvest. Join us via Zoom. Great to have you in the program. Good morning. And compliments of the season.
Good morning. Compliments of the season, Ladi.
All right, so which investment class would you say gave, some investors a white Christmas, with respect to returns this year?
Okay, thanks. I think the class of investors that I would say carried the day, those investors that invested in dollar-denominated assets. So trying to look at the trend, if we recall, looking at the parallel market rate, which is what is also applicable for investment, opened the year at 465 naira to $1, and based on market rate now is around 750 naira to $1. So for investors that invested in dollar mutual funds, dollar fixed deposits, those for euro bonds, a bit of volatility around that space. But I would say looking at their return should be over 60%. Because the naira depreciated in that segment of the market by about 37%. Then the second class I would refer to is those that were also able to take a bit of risk within the fixed income space, that invested in commercial paper because of the premium that it comes with relative to treasury bills. And I would say lastly is equities. But for equities, it's also going to vary depending on the sector. So when you look at it based on sector, the oil and gas sector rallied significantly, especially for Seplat, rallied close to over 50%. And you also look at the ICT sector, MTN, Airtel Africa, though Airtel Africa shared some weight towards the end of this year. But they also gained significantly. And within the banking sector, that experienced a lot of volatility. Was, I think, attained that yellow at around October, but we saw that rally in the last 3 or 4 weeks for some of the banking stocks. So by and large, I think it's when you look at it's also going to vary based on your portfolio. And earlier this year, we had also recommended that there should be more exposure to fixed income, dollar-denominated assets, followed by equities, because we all know that all the expectation as we walk towards the election, there will be a lot of uncertainty, and with the absence of foreign portfolio investors and also in the equities market, also impacted the performance that we saw. So I would say, in summary, that the winners or the winner would be those that took that step to invest in dollar-denominated assets.
All right. On the global front now, obviously we saw some, the equities that didn't do well on the global front, from like the tech-heavy equity markets like the Nasdaq, and some other categories. They didn't do well. Some are down about 65% year to date. Some 70% down. Do you think the bottom is in for those kind of assets, or are we close to the bottom?
Okay, thanks. I would say that looking at the equities global market, where we should be close to the bottom, however, still with a bit of caution. We expect that the US Fed begin to reduce the increase in the rates. So if you recall, this year, the Fed rate opened at 0.25% and will be closing the year at 4.5%. So that significantly affected rates in the global space. And with also the moderation we're expecting in inflation and the potential recession, which would mean that they will need to also encourage like an expansionary monetary policy, that would also boost equities. But it's still susceptible to a lot of global decisions in terms of geopolitical politics that would still have its impact. But we would recommend that investors that have that long-term investment horizon should begin to also take position. So if you look at the trend, even the US market, the S&P, the Nasdaq, Dow Jones, if you look at them the last 50 years, most times when these are periods when people are able to take that risk benefits, because we would expect that towards the end of next year, there should be a rebound, and they may also come to surpass their previous high, which we've seen when you look at the trend. So for investors, I believe that it's also time to, because looking at the correlation between the fixed income market as well as the equities market, as rates also begin to taper down, that would also be a major boost for the equities market.
And obviously, this year we saw, the commodities markets, also shine. We saw the commodities like natural gas, oil, grains. They did well. They all hit, highs, new highs this year. Do you think going into 2023, these commodities will still shine?
Hey, thanks. We need to first understand the reason why we saw that positive outing for those particular sector. You look at the oil and gas, because oil and gas sector, as well as the grain sector, because of the crisis in Ukraine, between Ukraine and Russia. Yes, even if the crisis may still be prolonged, which is still ongoing, we don't expect that sharp rise in oil prices again. There will be a bit of moderation. We don't expect it to increase by that percentage that we saw last year. So we believe that there may be a bit of moderations. Economies are looking for alternative, because it wasn't an easy time for most economies, given that rise we saw in crude oil prices, as well as grain prices that impacted significantly on even inflation in some of those economies. And alternatives are being sought for now. So we don't expect that amount of positive performances, but we still feel that the likes of the metals, gold, those that suffered significant downtrend this year may go move in the positive direction in the new year.
All right, let's hope investors have it easier in 2023. Thank you so much. Thank you, Mr. Ayodeji Ebo, MD Optimus by AfroInvest. Thank you for giving us your perspective today. Thank you, and
always
compliments of the season.
Same to you.
All right, so there you have it. We're looking out for 2023 to see which investment classes are going to shine, come 2023. And talking about investment classes, we have Will coming in now to tell us what to expect, right here in Nigeria, talking about the fixed income market and the equities market, because the equities market in Nigeria has performed well in 2023. Did have a shine. Let's have Will now. Will.
Good morning.
Good morning. So, yeah, quite a good run for the equities market this year.
We've seen a good run for the equities market. I wouldn't say so much for the fixed income, but we've seen some uptick with the money markets, but we don't know how that permeates other spaces in that, segment. We've seen some, downtrend in yields these days, and, just want to know what's really happening. Why is there, especially with the level of liquidity, why, I think the system is awash with liquidity. Maybe that's the reason why we're seeing a lowering in yields at the moment. But I don't know if that is the reason, but our analysts will probably give us maybe more insight
maybe
into
2023
that.
will be the year for the yields.
For yields. And now we'll be wondering, as I asked the other time, should we go for equities or fixed income? But I'm sure the major...
Quite a tough decision to make.
Quite a tough one. So we're going to talk to Dimeji Obasa, fixed income analyst, fixed income dealer, Access Bank, to give us more insights as to what to expect for the fixed income space, and also an outlook. That's how the market is going to close today and what to expect, in the coming year. Good morning, Dimeji. Are you there?
Morning, Will. Thank you for having me.
Dimeji, we're just going to have a quick one to know. We've just come out of the 2-day Christmas holiday and the market has been resting, but we want to know if they're coming out with a bang today. What do you project for today's close? Do you see yields still going lower or higher?
For today's NTB auction, we project that yields will stay relatively stable. Our projection is for the long end of the bills curve, that's the new 364-day bill, to be issued to close at 9.9% thereabouts at today's auction. So from last week, we saw that there was, because of the significant liquidity that came into the system as a result of the FAC inflows, we had demand, particularly on the shorter end of the curve, with long end bills trading to as low as 8.7%. However, we expect that liquidity would have been utilized last week. Coming into this week, opening on the first trading day, we have the bills auction, and we project that rates will stay relatively stable. On the bond side, we expect rates to stay relatively stable going into the new year. However, we project that we will continue to see demand, particularly for the on-the-run papers, the 29s and 37s going into next year. But then all of that will sort of taper off as we expect the DMO to release the new calendar for the auctions going forward.
So do you expect the money market to still trend up, yields in the money market?
So for yields in the money market, we expect yields to come down slightly. That's the OPR and the overnight rates. We expect them to come down slightly. On Friday, we saw some CRR debits by the CBN that caused a spike in rates, but we expect that to sort of taper off today, going in for the rest of the week.
Thanks so much, Dimeji Obasa, fixed income dealer, Access Bank, for your insights. Now let's bring in Oyinkansola Aregbesola, investment research analyst, ARM Securities Limited, to give us our own perspective on how the equities market is going to close today, and especially when investors are coming out of the holidays, we don't know if they're coming to bite or to invest. Good morning, Oyinkansola. How are you doing? It's good to see you, or it's good to have you on the program.
Thank you for having me. Okay, all right. So for the equities market, we've actually seen that it has actually been on like a bullish run for the past 6 weeks. And we saw that, especially last week, we saw like a week-on-week close um, of 0.79% upward, and the year-to-date figures is currently at 16.36%. And we can actually trace the positivity in the market to bargain hunting activities, by investors. Probably looking at stocks that pay consistent dividend or for capital acquisition. So I mean, we actually expect that coming into this week, we should actually expect the equities market to continue its positive momentum, and close the year in a positive terrain.
So this Santa rally, you're saying, is going to keep going, and investors are not going to let go of that bull, and they're going to just keep riding it into the new year. But do you see it in January and like in the first quarter of 2023, this sustained bullish momentum, or do you see investors pulling out to probably, cater for other needs?
Okay, so I mean, so we've already seen like price appreciation in some of these value stocks, and we expect investors to start their profit-taking activities, and it could actually slow down the positive momentum we've seen so far. And then looking at the new year, as for the new year, we are still working on our outlook in-house. But if we should look at like an early observation, points towards a positive outing for the Nigerian equities market.
So something hot dropped yesterday. We see Afrexim Bank, I think eyeing some shares in Geregu. How do you think that would work out for Geregu? Do you see investors, gulping that stock, that shares in the market today? Do you think we're going to see a jump in Geregu's share price?
I should actually expect like a moderate. We should actually expect like a moderate rise in its shares.
So that's looking. What's your the stock picks? What would you advise investors to look at the moment? Because I'm sure a lot of investors are wondering where to put their money and reposition, especially their portfolio, to balance it out, to be able to profit from the maybe last quarter earnings reports. The yields they're going to get.
Okay, so I won't exactly point out the particular tickers, but I'll say that the banking tickers are actually like a good place to look into for investors, especially for dividend-oriented activities or even capital acquisition, because most of the banking tickers are actually trading at a very low value compared to their fundamentals.
So do you think if there's trading below their value, their market value, what do you think is going to trigger an uptick in their share price?
Sorry, I didn't get that.
What do you think is going to spur that share price appreciation for these banking stocks that are trading below their market value at the moment?
Okay, so we've already seen like a rise. We've already seen a rise in its price already, based on the fact that some investors are already seeing the value in these stickers already. But looking at the Q release of its end of the year results, we should actually see we should expect the performance to be in a good terrain. Seeing the recent, the consistent MPR hike by the CBN, this should actually spur like an increase in its interest income of these banks. So we should actually see like a good performance, in their fundamentals, and it would spur investors to buy into this ticker more. And this should increase the price levels.
Thank you so much, Oyinkansola Aregbesola, Investment Research Analyst, ARM Securities Limited, for sharing your perspective and insights into the market with us.
Thank you for having me.
That's how we're going to end that, laddie. That's a forecast.
And I remember your forecast.
Yes, my forecast. Flattish positive. But like I said, I can't control the profit takers.
Well, I'll be looking out for that, please.
Yes, we'll look out.
Thank you so much, Will.
You're welcome.
All right, so we'll head on to London now, see what's happening there. We know the strike issue is still biting hard in the UK. We have Juliana there ready to give us details. Great to have you, Juliana. Good morning. So I heard Gatwick is told passengers there may be longer waits today at passport control as the strikes are still biting there.
Good morning, Laddie. Yes, strikes are still biting, and it comes at a really difficult time when lots of commuters are trying to travel back into the UK to see their loved ones and to start work. But it is going to be very difficult. We already heard this morning from Robert Jennick, who is a senior cabinet minister, asking passengers travelling into London to expect flight cancellations and long delays. And that's because the Public Communication and Workers Union, representing about 1,000 baggage handlers in the UK, are conducting a second series of strikes. They striked last week. It did cause minimal disruption, but we are expecting more disruption to happen today because, of course, it comes amidst other strikes. We're also getting strikes in the railways and also driving instructors. They're all striking as well. And again, Laddie, it's all over the same issue, which is pay, work and conditions. The PwC have put in a petition to expect a 10% pay rise because, of course, as with most people in this country, their wages are just not going as far as they used to. Inflation, as we've been discussing extensively, is at a 41-year high. And this is, again, a severe migraine for the Prime Minister, who decided on a political gamble before House of Commons went on Christmas recess. He said he wasn't going to negotiate with union bosses because of inflation. Inflation is what himself, alongside his Chancellor Jeremy Hunt, are trying to battle at the moment. It's way past the Bank of England benchmark of 2%. And the Prime Minister believes by pumping billions of pounds of pay rises into the public sector, it's going to give more money into people's back pocket and it could fuel inflation. So not great. It doesn't appear as if there is going to be anything on the table just yet. But as we know what is happening with this winter of discontent, it is starting to cause some worry amongst investors, and it could have long-term implications to an already beleaguered and embattled British economy. So if you are coming into the UK or you are flying today, particularly into London, Heathrow, Gatwick, Manchester, Birmingham, please do check with your airline before you travel. We do know that civil servants and military personnel are being ushered in to try and sweep up some of the backlog, but hours-long delays are still expected.
All right, so much there for the new Prime Minister to deal with in 2023. But I hope the Brits there have some kind of white Christmas even with the strikes. Thank you so much, Juliana. Thank you so much, Juliana. All right, now let's move on to other markets. Now we see, well, not a white Christmas, you know, in the crypto market there. We see Bitcoin there still struggling, trying to get that above that $17,000 resistance level, still hovering, you know, below it at this point, looking like 16,000 is looking quite shaky. And we see the sentiment in the market, 28 points, still fear. It's been fear all through Christmas, whole holiday period. It's been fear in this market, 28 points. But it's not extreme fear, which is not bad, just fear in this market. We didn't see greed this Christmas. Let's move over to the market cap there. It's lost that $800 billion level, down 1.88% this morning. Volume traded up 34.99%. That's from the sell-offs we're seeing this morning. Bitcoin dominance, 40.09%. That's up 0.13%. We've been at that 30% level for a while now, but inching up there, back at the 40% level. Let's look at the price of Bitcoin this morning, $16,636, down 1.51%. We're still seeing profit taking with Bitcoin at this time. Volume traded, less volume compared to yesterday, $16.46 billion. So that's 17K resistance, getting further away, you know, from it at this point. Look at the price of Ethereum there. That's lost the $1,200 level, trading at about $1,165. Talking about price of Ethereum, down 2.27%, just about $5 shy of that $1,200 level. Volume traded $4.67 billion. Let's bring in Rume Ofi now, financial market analyst. Hello, Rume. Compliments of the season.
Good morning, Laddie. good morning compliment.
Yeah, and obviously it's not a white Christmas for, those investors looking for some sweet price action, for Bitcoin this Christmas. But obviously the FTX issue, still weighing on the market at this time. What's happening now with FTX? We know SBF is in the US. They're answering to issues with the implosion of the exchange. What's happening with Alameda now? There's some talk about some wallets moving.
Yes, Laddie, I really want to say that the cleansing is still going on. There have to be some cleansing in this space so that people that are coming in the future would have some sort of confidence going forward. The truth is, the failure of FTX is not the failure of crypto. It's the failure of a centralized platform, right? So people should be really, really careful because people are actually out there saying crypto is failing and it's not going to go back to what it used to be in its glory days. So what happened exactly with Alameda Research? So Alameda is a sister company, even though it is not right to bring funds from FTX to that company. Alameda Research is a hedge fund formerly controlled by FTX CEO Sam Bankman-Fried. We usually call him fraud these days because of what he's into now. The truth is, he moved some money, actually moved from their wallet, right? Some money moved from their wallets, probably a bit of currency with the ERC20 tokens, right? They are being flipped for ETH USDT wallet. And the truth is that this is so clear because there's something that people misconception out there in the public. When people say, oh, crypto, you can use crypto to move large amounts of money without being knowing. Crypto you will be exposed if you want to do illicit activities with any cryptocurrency, even Bitcoin inclusive. So the wallet 0x4EQ received over 600 Ethereum. That was figured out by members of the community, the crypto community. They can figure that out. We can research it. Myself inclusive can do a whole lot of that as well. Then on-chain analysis from Zach SBT actually noted that Alameda Research sends some swap coins to Bitcoin, trying to move it out to a decentralized platform called Fixed Flow and Change Now. So those platforms are platforms where hackers move money to hide the transaction route. But people where the money is heading to, the traces, the footprints are still going to be there. So that's the uniqueness of the crypto space. When you are moving money, thinking that is anonymous, it is not as it is. You are going to be exposed if you tend to make any attempt. And the truth is that his bail condition states that he's not going to be having access to internet connectivity and computers and all of that. But it's so shocking that immediately the bail happened, where he was bailed with about $250 million worth of bond. All of this in Alameda started moving. And we also understand that about $300 million, about $300 million moved immediately. They filed for bankruptcy and they said they were hacked. So all of these put together are beginning to get some clarity because these guys are trying to hide under the technology, cryptocurrency, but they are still leaving traces, which it is also very important for the space and the blockchain. It gives you opportunity to get information that you think might not be available to the public.
And Rume, it looks like this FTX issue is still going to be with this market, obviously, even going into 2023. But do you think at some point investors might forget about the whole FTX issue?
Yeah, so like I said, it is the failure of FTX and not the failure of crypto. Crypto serves the purpose where values can be transferred via the internet. So we can say crypto is the money of the internet, Bitcoin and others inclusive. So it is going to move out. This phase is going to move out with the fact that all cryptocurrency, all coins, be it ERC20 tokens that don't have intrinsic value, that is solving a particular problem, then we all phased out with all of these things happening. It's quite painful now that we might see a big shocker going forward in 2023, but we need to all learn how to breathe underwater for now.
All right. I guess the crypto market is getting used to black swan events going forward, but it'll be interesting to see how 2023 plays out for this market. Thanks so much, Rume Ofi, and do have and enjoy your holidays. Thank you so much.
Yeah, thank you, lad. Pleasure.
All right, so we flip over to the top alts by market cap. We see it's all red this morning with BNB there. Not much going down there, 0.06%. We see Cardano, the biggest loser this morning, 25 cents. It's down 4.66%. So this market is still very fearful. I'm still seeing a lot of sell-offs and profit taking in the market for the crypto space. No Santa rally, obviously, that's over. Maybe some kind of New Year rally if these FTX issues don't continue to weigh on the market. All right, that's it for the market today, and that's a wrap on the program. Don't forget to join us at 1:30 for Business Incorporated. More updates and developments in the world of business. You can watch this again on our YouTube channel. Just flip over to YouTube, search for Channels Television, flip over to videos, and you can watch all our productions. Thank you so much for watching. I'm Ladi Williams. Bye for now.